Good morning and welcome to your Tuesday, January 7th market news update. Euro traders await patiently for the bloc's preliminary HICP reading for December. The US Department of Defense blacklisted Tencent, accusing the company for collaborating with China's military complex. The British pound extends rebound from 9-month lows as the dollar retraces its steps. European stocks trade in the greens for the second consecutive session as inflation data from France lifts hopes for further ECB easing. Jeweled shops openings data serve as a sneak peek ahead of Friday's NFP print. Persistent weakness in the yen triggers yet again another verbal intervention from Japan's finance ministry. Finally, Meta appoints UFC boss Dana White to its executive board. That's all for now, and stay tuned for tomorrow's market update.
Hi, everybody, and welcome to another daily presentation. This is the market overview for the 7th of January of 2025, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first and sole topic of the day is going to be about the Eurozone, more specifically about Euro area's inflation, which has risen to 6-month highs. Now, inflation across the bloc rose to 2.4%. According to the preliminary reading for the month of December, and has hit its highest level since July of 2024. This data came in earlier today, and we felt the need to discuss it. So even though the rise matched economists' expectations, worries for a more cautious approach from the ECB policymakers team in regards to cutting rates in 2025, have now started to echo across markets and have nudged forecasters to reconsider their projections going forward. The euro has risen on the back of these data and extended its rebound from 14-month lows. And at the end of the day, this was the euro capitalizing on the shortcomings of the dollar, which are short-lived. This is, if I'm not mistaken, the third consecutive session that we see the euro gaining ground against the dollar, but it's not due to primarily euro strength. It's probably due to the weakness in the greenback. Now, a risk-on approach, however, has been closely held by European equity traders, and we continue to see that with the Euronext 50 index, which is gyrating aimlessly around the 5,000 key psychological area these past few months in hopes for a bullish catalyst. This kind of extension is seen safeguarded from this kind of data. Since the primary reason behind this is a series of destabilizing political developments in both Germany and France, which have casted doubts on the homogeneity but also the cooperation of the bloc's nations and the efficiency and their efficacy of going ahead and coexisting with each other, but also the projected impact from Trump's policies which is adding much more fuel into the fire and creating another dimension that is, at least from the eyes of economists, foreseeing to see some sort of prolonged weakness in the euro area as a result. Okay, we will see whether that is going to be the case in the coming months. Again, not good news coming up from Eurozone. We'll see how the whole thing unfolds as we progress deeper into 2025. For the time being, we're going to keep this session short, guys. Thanks for watching, and hopefully we're going to catch you on to tomorrow's um, session for another brief update. For the time being, take care. Bye-bye. Hi, everybody. Welcome to another webinar. I apologize for the delay. I had to restart the computer and get the setting up and running correctly. Once again, I had some issues with Zoom as well. So hopefully now everything is up and running correctly. Can you please, guys, let me know in the chat whether you can see the first slide of the presentation, whether you can hear me loud and clear. I think I've enabled everything in the chat. Please let me know. And we will be on our way quite shortly because we're back from schedule. Okay, so thank you for the thumbs up, Austin. Hi, Nick. Yeah, Nikita, Nicola. Okay, I see people joining. That's good. Again, apologies, guys. And yeah, welcome to another webinar. Today we're going to do technical analysis. Once again, today we're going to focus primarily on Fibonacci retracement. Again, super easy and basic stuff. We're not delving into anything more advanced for the time being. The point is to understand the concepts. Again, easy to implement them on your charts, understand their implications, what, if, in a sense, information they convey, and how you can use them appropriately while you, in a sense, adopt that with your trading strategy. Okay, so Fibonacci retracement. Without further ado, let's get started. This is a quick risk warning and a disclaimer. I'm not going to go over this. You can read this at your own time. So we have mentioned many times in the past that there are several types of technical analysis, different ways of classifying the indicators that fall under the technical analysis kind of branch, if you like. So this split, we're talking about mechanical analysis, and you have on-chart and off-chart indicators. Again, this is one simple way of comprehending what makes some indicators similar and others different. And in a sense, we have here a split of on-chart and off-chart indicators. In the past, in a sense, on-chart indicators go on top of price action. Off-chart, we have them, as the name suggests, on a different panel. Either, probably most of the times, is below the chart, is not overlaid on top of price action. Hence, most of the on-chart indicators are called overlays, and the other ones, the other category, which is off-chart, call them oscillators, and they are found on a different panel. That's not that much of importance for the time being. So We have covered in the past moving averages, Bollinger Bands, and Fibonacci retracement, which we're going to cover today in much more depth, if you would like. So also we have covered RSI, moving average convergence and divergence, momentum as well. So again, today is going to be about Fibonacci solely. So what is Fibonacci in general? And then we're going to talk about the Fibonacci retracement as a tool when it comes to technical analysis. So it's going to be a brief overview of what the Fibonacci is, and then we're going to do the practical application, that the one that is in a sense applied to technical analysis. So Fibonacci sequence was identified by an Italian mathematician named Leonardo Bonacci back in the 13th century, so goes way back. However, it is widely believed that Bonacci did not come up with the sequence himself, but the sequence was introduced to him by, or the concept at least was introduced to him by some Indian merchants, and we have early evidence, if you would like, that this kind of ratio was firstly identified. I don't know if it was popularized back then, but it goes back to the 6th century BCE in ancient India. So the Fibonacci sequence is closely connected to what we call the golden ratio, which is the 1.618, which in other words is also known as the divine proportion. And this kind of ratio can be interestingly found in many aspects of life, if you like. For example, you can spot this ratio in sunflowers, the actual plant, in galaxy formations, in seashells, in historical artifacts, in architecture, in many different kind of, again, aspects of life. Okay? So this is something that is observable and measurable throughout nature. So that was the initial thought of traders and technical analysts back in the day. You know what? We find this ratio pretty much everywhere around us. Why not apply that to technical analysis as well on, in a sense, price action or price of any given instrument, in a sense, and try to spot this kind of ratio, mainly because they believed that it might have some sort of significance. Okay, since we spot this ratio in nature, why not spot this in financial markets as well? This is the rationale. This is the thought process of traders and technical analysts back in the day when they first tried to popularize and introduce this kind of concept to trading. Okay, so we talked about Fibonacci. What is the Fibonacci sequence in a sense? Okay, so it's a sequence that starts with 0 and 1 as the prime components. Okay, and each subsequent number is the sum of the previous two numbers. So we start with 0 and 1. You add 0 and 1 together, you get 1, and then you get 1 plus 1, you get 2. 2 plus 1 is 3. 3 plus 2 is 5. 5 plus 3 is 8. 5 plus 8 is 13, and it goes on in a sense indefinitely. You can use this kind of quote unquote principle, adding the last two numbers together and get the new one. If you continue doing that with these kind of numbers, starting with 0 and 1, this kind of series of this kind of sequence of numbers goes on indefinitely. Okay, so when it comes to trading, however, practitioners commonly use this ratio and many other ratios, that are extracted from this Fibonacci sequence in order to establish, at the end of the day, support and resistance levels, which can be useful when it comes to entering or exiting a position, measuring how far a price action is expected to pull back or retrace once you hit, for example, a fresh high, or how much a price action could rebound from reaching a fresh low. Okay, so the primary usage of the Fibonacci ratios are for just that. Okay, the main benefit, okay, of using the Fibonacci sequence and the Fibonacci ratios is to establish support and resistance levels. That does not mean that these levels are valid. We have to be clear about this from the get-go. They are used as supplementary information for a possible pullback or retracement or rebound from a specific kind of after a specific move has ended. Okay. So for example, imagine price action rising and peaking, and then you use the Fibonacci retracement tool in order to measure how far the price action may fall towards to. That doesn't guarantee that it's going to rebound or fall and stop near the 61.8 level or the 38.2 or the 23.6. They're used primarily to, in a sense, diminish kind of entropy and not knowing where the price action may be. That's why you use the Fibonacci ratios, okay, to get a glimpse of where we might possibly see the pullback ending or stopping or reversing the price action from there onwards. Okay, they do not have predictive powers. Please digest this as soon as possible. They are not telling you that certainly the price action is going to fall to that level and rebound from. No, you use them as supplementary tools to your original and your fundamental kind of technical analysis and technical tools that you use in order to gauge where the market is going. Okay, is not, please do not use Fibonacci retracement in and of itself and think that it encompasses everything you need to know about that specific price action. Okay, please use this as a supplementary tool, which that's what its purpose is from the get-go. Okay, so again, please do not think that this has predictive powers. Okay, so at the end of the day, what we care about are the ratios. We mentioned them again many times in the past when we've done the introduction to Fibonacci. Let's refresh our memory once again. So we have the what we call the 61.8% level or the 0.618. We have the 38.2% level, the 23.6% level, and many traders also use the 50 because it's half of the distance of a specific kind of move. So that kind of makes sense. And sort of way, even though the 50% level of 0.5%, 0.5 is not an actual Fibonacci number. It's an additional level that traders most of the time use when they're trying to assess how far a pullback may go. Okay, so again, the reason why we use the Fibonacci retracement tool more specifically is because any given instrument in financial markets does not move only in one direction. Okay, the market has cycles that is evident, that is obvious. Okay, what we're trying to achieve is that when price, for example, of a specific instrument rallies significantly and moves way away, way apart from what we call the mean. Okay, it is reasonable to believe that price action at some point in time will because it went way ahead of itself, it's going to reverse back towards the mean. So that's what the principle, that's the principle that the Fibonacci retracement tool is predicated upon. That price action, yes, moves to one direction, but then comes back a little bit, okay, to catch in a sense its breath and continue moving to that direction or pivot away or reverse. That's not the point. The point is we use the reversion towards the mean principle. Okay, and from this kind of quote-unquote principle, this market wisdom, if you would like, we, in a sense, use the Fibonacci retracement tool to measure how far and how much the pullback may be, the retracement may be. Okay, so it's all starts from there, and we're not going in much detail about Elliott waves and all that kind of stuff, which currently fits neatly with this kind of with the usage of this kind of tool. We're not going to go into Elliott waves, super complicated topic. We're going to have a webinar about this in the future to understand how the waves are created. Okay, and there is some sort technical analysts, at least the ones that use Elliott waves, they do believe that there is some sort of predictability in the way the waves are formed and how far they retrace and rebound from. Okay, we're going to leave that for a different webinar. For the time being, let's focus on Fibonacci retracement. Again, the key levels are 61.8, 38.2, 23.6, and the 50. You can also add the 78.2. Okay, there's many of them. The most significant okay, from in the eyes of market participants or technical analysts are the 61.8 and the 38.2. Let's see why. Okay, so again, Fibonacci retracement, we mentioned what the sequence is. It starts with 0 and 1, and you add the previous number with the one you have in front of you, and you get a new one. Okay, we mentioned this. So the Fibonacci ratios, we mentioned that 61.8, the 38.2, the 23.6. How are they calculated? Pretty simple. So you, in a sense, divide any number in the sequence, and we mean any, by the number that immediately follows it. Give me 1 second to get my calculator up just for your visual illustration. Yep. If the wording does not reach you, I mean, you don't understand what I mean by words, let's do it by numbers. So, for example, let's pick the 21 and you divide that by 34. So the one you have in front of you, let's choose the 21, and the one that falls after it is 34. Divide that, you get 0.617, and you round that up 61.8. You can do this with any number except the first, I don't know, 5 if I'm not mistaken. So you can do the same thing once again. Choose 34 now, and you divide that by the next number that immediately follows it, 55. Again, 61.8. You can do that with the 55, divide that by 89, the one that immediately follows it. You get 0.6179, round that up, 8. Okay, so you get the point. Once you divide that number with the one that immediately follows it, okay, you get the 0.618. And when you do the same thing, for example, with 21, divide that with the two numbers forward, which is, for example, in this case, 55, you're going to get what we call the 0.38.2. Okay, so we round that up to 2. Okay, you can do that with any given number as you progress through the sequence. Okay, once you go from 89 onwards, okay, and you add, I don't know, complex numbers, the ratios, the 0.618 is becoming much more clear. Okay, it's not going to be 0.617. That's not the point. Okay, so if you want, for example, in this case, to get the 23.6, you do 21, divide that by 89, and you get, okay, 23.6. Okay, so the number that you choose and dividing that number with the one that follows it gives you 61.8. The number that you choose with the two numbers down the line, you divide that, you get 38.2. Choose a specific number and you go 3 numbers down the line and you divide that, you get 23.6. This is how the ratios are calculated. Okay, so now that we've done these calculations, how do you apply that to your chart? You're not going to do this manually. You have a tool for that. It's called Fibonacci retracement. So what you need to do is, in a sense, draw 2 extreme points on a chart, and the technical indicator, in a sense, creates this kind of vertical distance and spits out the Fibonacci retracement tools. Okay, we're going to do that live after we finish with this presentation. Okay, we're going to go on a live environment and do a small base case kind of scenario with any given instrument, applying Fibonacci, the principles of Fibonacci retracement, the Fibonacci retracement tool, and add many other stuff to it, and see whether I can take actionable kind of decisions while using that information. Okay, for the time being, let's finish with this. So in a sense, you draw from the bottom to the top if the market is moving to the upside anyways. So you connect 2 extreme points, and the Fibonacci retracement tool spits out the key levels. What we need to do then is see whether those levels are valid, and how you can see whether those levels that have been spewed out are valid. You go backwards in time and you do proper setup of support and resistance level. Do those levels coincide with previous levels where price action has rebounded from, or has found in the past strong resistance? Then yes, that level may be okay, may have some sort of significance in my expectation towards the retracement. Okay, so you need to double check or cross check, in a sense, prior past levels that have impacted the price action of that specific instrument in the past. And once you see an overlay, okay, an alignment between those levels with the Fibonacci, then you have a little bit more confidence that these levels, the new levels that are spewed out by the Fibonacci, may be significant. Again, notice my wording, maybe. It's not guaranteed. Okay, so at the end of the day, these levels can act and do act once you use the Fibonacci retracement tool as it is intended, as merely support and resistance levels, are charting out possible support and resistance levels. Okay, you can take from there onwards, again, create a strategy using this kind of tool according to your liking. Okay, you might play a rebound, you might in a sense scope your way out between levels. There's many ways to play this. Again, let's do this on a live environment. Okay, so 0% is the start of the retracement. Okay, so from the bottom, in a sense, to the top, which is the 100%, the complete, excuse me, the other way around. So 100 is the bottom, 0% is the top. So is the complete reversal of the move, the 100%. If that comes down here, I don't know if you can see my mouse pointer, hopefully. Okay, and again, the 38.2 and 61.8 retracement levels are considered to be the most significant according to market wisdom and those that actually use it. Okay, there's no empirical data supporting this. It's just what traders have observed when trading in financial markets and using the Fibonacci retracement tool. Those are the two levels that have turned out to be the most important. Okay, again, other people like the 50% as well and the 23.6. Okay, it's up to your liking, but the most significant ones are 61.8 and 38.2. Okay, so Fibonacci retracements are a method of technical analysis for determining support and resistance levels. I'm getting tired of repeating myself, but please understand this. Is nothing else to it. It's just support and resistance levels. Okay, they are named after the use of the sequence we just mentioned, and the Fibonacci retracement is based on the idea that markets will retrace a predictable, quote unquote, predictable portion of a move after which they will continue to move in the original direction. Again, stems from the Elliott wave principles and all that kind of stuff. Leave that for a different webinar. Okay. The Fibonacci retracement is created by taking two extreme points, we just mentioned, on a chart and dividing the vertical distance by the key Fibonacci ratios. 0% is considered to be the start. 100% is considered to be the complete reversal to the original part of the move. Now, once these levels are identified, horizontal lines are the ones that we use as support and resistance levels, are drawn and are used to identify possible support and resistance levels. How do traders use this? Since this is one of the most common technical trading strategies, again, I don't know if it's a strategy, it's a technical tool that is used to construct a strategy around it. Okay, traders could use Fibonacci retracement or many Fibonacci retracement levels to indicate where they would enter a trade or exit on the same kind of token. Okay, so for instance, a trader notices that after a significant momentum, a stock has declined towards the 38.2% level. As this stock begins to face an upward trend, they decide to enter the trade. Okay, they have seen enough evidence that that specific instrument has ended its retracement process. Okay, and from there onwards, they extrapolate that the specific instrument or stock or whatever that might be is going to continue moving towards the primary direction after, in a sense, the pause. So because the stock has reached the Fibonacci level, it is deemed a good time to buy. And again, from my personal bias and opinion is that is not sufficient. Okay, whether, for example, price action falls to the 38.2 level or 61.8 level, that is not sufficient in my eyes, from my point of view, and from my own personal bias, that is a good enough reason for me to enter the market and go long there, extrapolating that it's going to move to higher ground. Okay, I need to see, personally speaking, once again, many different other stuff, many other technical indications that coalesce, that come together, that converge, that give me much more confidence. Okay, and they raise the probabilities for me of placing a correct trade, rather than using solely the Fibonacci retracement tool as a mere entry or exit point strategy kind of thing. Okay, so that's my own personal bias. I like to see many different stuff, okay, coalescing together. So some may like to trade this purely with Fibonacci retracement. Fair enough. If you can be profitable doing this, do that. So some traders also combine other key data provided by indicators to confirm whether the expected move will be played out by rationalizing probabilistically rather than thinking that the levels provided with the tool can be taken for granted. Okay, so again, putting many other technical indications and see whether they converge or not. Are they giving you the same signal? Okay, that indeed the price action is going to reverse to high ground or not. Okay, check that as you go. So this is a visual illustration of how the Fibonacci retracement tool can be applied to any sort of given instrument. In this kind of case, we have New Zealand dollar against the Kiwi against the greenback, New Zealand dollar against the United States dollar. So 100% is, again, as we mentioned, the complete reversal of the move. Let me get my what is the complete reversal of the move? Okay, 100%. Whereas the top, okay, is the 0. So 100 and 0, kind of counterintuitive, but yeah. So these are the key levels. Do we have a pen here that I can use? Fortunately, does not allow me. Okay, so what we do here is, if we can deem this snapshot of NZD USD as, and we can brand this kind of move as a primary move, okay, this rapid surge of price action to high ground. Okay, so we see in a sense that we've drawn from the bottom to the top and assume that from this level onwards, from this line onwards, this has not yet happened. Okay, so let's assume we're currently somewhere in here. We see a price action peaking, and we drew the Fibonacci retracement tool in order to map out any potential sort of areas or levels that we may see the price action rebounding from after the complete after the finalization of the retracement period. Because as we mentioned, prices, yes, tend to move to one direction, but they take some sort of a pause before continuing onwards. Okay, this is a prime example. We see price action peaking at the top, double top. From a purely technical standpoint of view, this may be considered to be a reversal kind of signal. In this kind of case, it was kind of valid. Okay, you see price action retracing to lower ground, not being contained within the 23.6% area or range. Okay, and then extending the fall towards prior levels. Okay, that we see they have seen the price action stalling at. Okay, without looking at the right hand side, in a sense, from the high right hand side of the chart, this area here is, without using the Fibonacci tools, would have been, in my eyes, an area that I would have had placed significant attention to. Okay, irrespective of using the Fibonacci retracement levels, because this was an area in the past that we saw a small pause in price action. And you can draw, if you like, two parallel lines, much like we see here with the Fibonacci retracement tool, which kind of overlays nicely from. that this has been a nice range, a nice trading range, okay, for what, a period of 7th of October until the, let's just say, the end of October. So 3 weeks, you have seen price action struggling to either move upwards or downwards. It was contained within this area. So without using the Fibonacci retracement tool, I have my eyes and my sights on this kind of area for awaiting for a possible containment of price action, okay, not allowing the price action to move to lower ground. So that means, in other words, that this area right here would have been a flagged area beforehand for me to expect that price action may find support there, okay. So the Fibonacci retracement tool kind of validates my preconceived kind of bias that this area would have been a support zone, okay. So after we see the complete breakdown from the definitive breakdown below the 23.6 here and the rapid fall of price action towards the 38.2, we see some sort of pause taking place there, okay. That's a good sign, but we see also a definitive break below the 38.2, okay, and we go all the way down to 50, where we see the first rebound, in a sense. Substantial, not substantial, but quote unquote significant rebound, mainly because we have crushed the 23.6, the 38.2, and now we're down to 50. Obviously, the key is the 61.8, which fits kind of perfectly in this kind of scenario, okay. But as we saw the 38.2 level being crushed and we see the price action falling to the 50 level, we're gonna get much more confidence that these kind of levels are going to be tested significantly as well. We see breakdown slightly below the 50 level, which has been an area, again, irrespective, in the past that acted as support. We see the first rebound crossing above the 38.2. Again, another double top, signaling significant pressure from the bears. The bears are in control and they continue to push the price action to lower ground. The fact that we have, in a sense, created a higher low here is another sign of confidence, okay. That means that the bulls are eager to push to contain at least the strength of the bears and keep the prices to high ground. But that ultimately did not last long. We see the breakdown below the 50, and now our eyes are fixated upon the 61.8 to see whether this level holds or not. Because if the 61.8 level didn't hold and we see the breakdown below the 61.8, then we have high confidence, okay, not to play the long game but the short game. Because if you see the complete breakdown by a definitive kind of manner with a strong kind of move, we have high confidence that the next level to be tested is going to be down here, the 100. So we bet from there onwards that the complete reversal of the move is more likely rather than a reversal, okay. So you get, sometimes you will see the breakdown below the 61.8, but not by a lot, okay. You may see the price action edging somewhere in here and then rapidly retracing, okay. Sometimes you see the complete breakdown and the rapid fall below that, okay. So in this kind of case, we watch like a hawk this kind of level to see whether it will stand, and what other parameters do we need to see in order to have much more confidence that the price action is going to rebound from this level onwards. Is much like it happened in this kind of case, a double bottom, okay, which is a nice signal by using only candlesticks, okay, and no other technical indicators, that the price action is going to rebound strongly from this level. And if in this kind of example, it kind of fitted nicely and must say perfectly. We see two touches on the 61.8 and then a rebound, okay. A small hesitation near the 50, but here above the 50 is where I'm going to start looking to place long orders, not down here, but once I see the actual formation of a bottom, Okay, we see one attempt for the bears to push the price action to lower ground. No. We see a second attempt. No. The bulls are eager to push the price action to higher ground. We see a small, slight setback here, but we create a new higher low. This is where I start to pay attention to. And once I start to see the price action breaking above the arbitrary 50% level, then somewhere in here, I start to place a long order. Now, where your exit might have been, that depends upon the trader. Some, as I mentioned in the past, in the previous slides, some traders like to play in between these kind of ranges. So, for example, go long somewhere in here in the 70, what is it? 74.8, let's say 70.75. Let's just round it up and have a target, an exit target, for example, at the 23.6, at this kind of area. Okay. Some others have much shorter kind of time frames and short horizons. Okay. When it comes to trading, they may scalp, for example, from the 50 until the 38.2. Okay. That depends upon your liking. Now, for swing traders, this is actually the entry point, and the exit point is much higher than that because they have much longer time horizon. They are more willing to allow the price action to unfold and apply, in a sense, play with the rules, quote-unquote, rules of the Elliott waves, since you have this first wave, the pullback, and then the second wave after the completion of the wave, in a sense. Okay, they may have a target somewhere up there. Okay, so above the completion of the initial leg. So there's plenty of ways of playing this. Okay, so again, a possible short to medium kind of term is definitely not a short kind of medium. So a medium term, you might have had an entry point near after you see the break above the 50 level, and you have an exit target somewhere around the 38.2 or somewhere in this kind of area, which has been a resistance level, has turned into a resistance level now, or between the lines. Okay, when using Fibonacci retracement in and of itself, without using any other things. When you use other things, you get different interpretations and different signals, or much more accurate, in a sense, levels where you would expect to see the pullback. Okay. Again, you see price action rebounding from 61.8, breaking above the 50, breaking above the 38.2 with a nice, solid kind of move, but stalling at the 23.6. Okay, pullback, small retracement, small setback. This area right here, this higher low, this is from a macro, from a zoomed out kind of point of view. This is the first low. This is a higher low. Very nice signal for you to interpret as, you know what, the next wave is going to move upwards. Okay, the price action is going to move to high ground. Okay, it has stalled in the past, once again to the 23.6, retraced back to the 38.2, yes, but rebounded strongly from here onwards. So if you missed this kind of wave, an area where you'd be paying attention to is this. After you see this nice consolidation, go long somewhere in here. Obviously, you would have been within a loss if you had an upwards kind of a target up there. But if you have left it long enough, they're going to go your way, because you have, again, it abides with the principles of the wave. Okay, so there's many ways of looking at it, from a super zoomed in perspective, from a medium term to short to medium term, long term, etc. So zooming in and out is beneficial for you to understand how the whole thing unfolds. Okay, and you can act accordingly once you train this kind of zooming in and out kind of perspective. Okay, so enough about this example. Completely a complete opposite scenario is here, so not much different. So let's just say the end of the move was here, the start of the move was there, the 100% was at the top and 0 at the bottom. So draw here, and what in this kind of scenario we see is not exactly identical, but in this kind of case we don't see the price action rebounding, not pulling back, retracing in a sense to the 61.8. The retracement or the rebound was not that harsh compared to the prior example. We've seen price action stalling, okay, not allowing the rebound to go further past the 38.2, and the bulls in this kind of case attempted once, attempted twice, attempted 3 and 4 times. Okay, so this is a clear signal there is a strong resistance ceiling there. The bears are not allowing the bulls to take the initiative and push the price action to high ground. So once you see 1, 2, 3, 4 touches, inability of the price action to break past this level, now we set our sights for a short order and the extension of the primary move to the south. Okay, so from my own personal liking, the short order most probably would have come somewhere in this kind of level after I see this, the obliteration of this small kind of hurdle that may have been acting as support. Once I see the clear breakdown below this level, okay, now I'll place a short order. And again, where is my sights? Where are my targets for exit? Down here, okay? So this is a move you could have, in a sense, not scalped, but day traded, okay? Again, once you see, however, price action finding support slightly below this kind of area, the fact that you have 1, 2, 3, 4, 5, 6 times the bulls resisting the bears push, okay, then I start to see, once again, a retest of the prior Fibonacci level of the 38.2. And in this kind of case, it nearly moved close to that, but it didn't actually touch the 38.2. But again, something I failed to mention is that please do not treat the Fibonacci ratios as, yes, you're going to place support and resistance levels there, but do not interpret them as levels. I mean specific price. For example, the 7.09130 as a solid support level, resistance level. Use them, interpret them, analyze them, and conceptualize them as areas, okay, as ranges, not merely as levels. Oh, you know what? If it hits the 38.2, then I'm going to place a short order. Oh, no. In this kind of case, you would have missed out, okay? So treat this as an area, okay? It's not exact science. It's obviously it's an art. So you see in this kind of case, bulls regaining control, rebound, pushing the price action to higher ground, retesting, in a sense, the bears' strength, but they fail once again near the 38.2 level. And from there onwards, it's in their absolute control, okay? So short order might have come somewhere in this kind of level after we clear this trading range. So short order there, again, target might have been down here once again, pretty much the same move, okay? Or if you have a longer time kind of horizon, just keep the position open to swing the whole thing, because you have once the major move is this, testing, okay, rebounding here, retracing up to here, retesting twice, okay, not going anywhere, then you have much higher chances or much higher confidence that the move is going to extend to lower ground, okay? So enough about the visual illustration. Let's go on to a live environment to just do what we just did together. If you have any sort of preference, please let me know, guys. I'm going to pull up a chart from TradingView right now. What do we have in front of us? Apple. Okay. If you have preference, guys, please let me know. If not, sorry, I'm gonna choose one randomly. So what else do we have here? Let's go with let's go with gold, silver. Okay, let's go with gold. Okay, so let's start out from a kind of long-term kind of perspective. This, in a sense, Fibonacci retracement. This is the beginning of the move, and this is the top of the move. Okay, so let's drag that a little bit further. Okay, so I don't know if it's going to be much of help if we look at gold and from this kind of perspective. There's certainly loads of speculation surrounding gold for the time being. We will see whether this is going to be a mere pullback or whether this has been the end of the pullback or whether we're going to see a much sharper retracement from gold. Okay, so let's do something else, however. Let's use support and resistance levels to areas that we clearly see as have played some sort of significant role in the past, or which are the ones I'm going to highlight right now. Let's do, what is it? Horizontal ray. Yeah, this one. Okay. So again, could have had this from down here, but it's way too extreme, I think. Let's go on a much shorter kind of time frame, which is obviously not that kind of short. So what do we see here? This is the former all-time high level that was tested once, tested twice, tested 3 times, but ultimately we see the break above this kind of level kind of clearly within the past, few months now. Since the start of March, we see this ludicrous rally of gold. So that is an area of support that I would expect to see coming into action if the pullback is gains momentum, if you will, like, or the retracement gains kind of strength. The bears enter the picture. So again, this is far away from where we are currently, but still, see how it kind of nicely fits with the 61.8 level. Again, do not use the line, we use ranges. So obviously this area without the Fibonacci retracement tool would have been important in my eyes anyways. So another area that would have been and is important in my eyes is certainly this. And you see the price action moving higher here, failing to break past this, retracing, okay, pulling back a little bit, retesting, ultimately failing, and then the third time he manages to break above it. Okay, so this area for me is certainly an area that I will be paying close attention to if we see the retracement from here. Apart from here onwards, yeah, you may see this kind of rebound. Okay, might have been due to some sort of intense or worthy deep buying opportunity for gold. Okay, so these are areas that I would be paying attention to. So in this kind of case, the 23.6 and the 38.2 alongside the 61.8 are indeed valid levels for me to expect. Now, what to expect from here onwards? Not much really, because it has an upward kind of moving trajectory anyway. Let's do the trend line in order to validate this and see this kind of clearly in this kind of case. Okay, so we have, this is the low. Let me get, this is a low, this is a higher low. Okay, higher high here, another higher high here. So it's obviously the market moves to higher ground. Okay, we will see now whether price action is gonna come back down towards here, or the retracement. It raised everything. Lovely. Okay, so let's do that once again with a different instrument, I think, because gold does not provide us with any sort of lovely clues. Let's do Nasdaq, pretty much the same thing as well. So let's do it from a small kind of perspective, a shorter kind of perspective. Let's go with the 4 hour. Okay, let's assume that the start of the move is this. This is the peak. Let's see whether it aligns with any sort of given Fibonacci retracement tools, ratios. Okay, so areas, once again, let's do the support and resistance, which is, where are they? trend lines, no, horizontal race. This area right here is definitely something I will be paying close attention to. Form a, okay, higher low, a high, excuse me. So we start from here. You have higher low here. This is the higher high, higher low, higher high, a higher low, another higher high, higher low, etc. We see some sort of stalling in here. Okay, so this is certainly a peak. We may see that, we may judge that this move has, in a sense, been depleted. Okay, so you do make higher highs, but not with the same magnitude and ease that you have done in the past. So if we plot, for example, an RSI indicator below our chart, you're going to see clearly a lovely divergence. Come on, man. Okay, it does not allow me for some reason. Okay, so after we see the peak, now we watch closely to see whether how far the retracement will be. In this kind of case, we see price action coming back towards this level, is near the 38.2, rebounding from it, okay, and attempting to move to higher ground. Yes. Yesterday, we're probably going to have an open in the greens. Maybe, we're going to retest this kind of area right here once again. So a clear break above this kind of level is cannot be interpreted as a long signal. Obviously, the momentum is with the bulls now, so it's best not to trade against the trend, but we will see whether that is going to come into fruition in today's session. So for my personal liking, for me to start paying close attention to get deep buys into this, okay, is when and if I'm going to see a breakdown below this ascending trend line and a break below here. So an area, or an optimal area to enter a position for me is going to be somewhere in here. So for example, if where is this long position? An ideal position for me would have been to see some sort of breakdown below the ascending trend line, a break below the 38.2 in order to see that pullback or the retracement is actually gaining momentum, and also to get a lovely, a much nicer risk reward ratio in order to worth me entering the market, entering the market. So ideally, if it comes down here, I will have some sort of bias to go something like this. Okay, an ideal scenario for me is for the price action to again cross below the ascending trend line, break below the 38.2, and come somewhere in this area, maybe finding some sort of support. And after I see a clear sign, okay, that you know what, the price action has indeed rebounded from the 0.5% level, heads to higher ground, then I will have a long bias on this for the time being. If, let me erase this, if we see the price action falling down from here and breaking below the ascending trend line, being ready to challenge this kind of level, I will be short biased, okay, after I see this breakdown below this. Okay, I need to see the confirmation. I need to see the break below that by, oh my, this is not going to leave us work today. Sorry, guys. Apologize for this. Let me do this whole thing once again real quick. So the ideal scenario for me is going to be based upon many factors. It's not going to be only purely on Fibonacci retracement tools, okay? What I would like to see is the complete breakdown below this kind of level or this area. Let me find these. What is the tool for rectangles and stuff? So this area is crucial for me. Okay, I need to see a complete breakdown below this price action. of the price action below this kind of level. So in order for me to place a short order, so for me, ideally would be somewhere in here and have a target somewhere down there for a take profit and a stop loss up here. Okay, so a risk reward ratio of 2.55, that's decent. You can play this only using Fibonacci retracement tool, but given this alignment, this lovely alignment, you can clearly see here. Okay, I have high confidence in this kind of trade if and only if I see what is it, price action falling back below the ascending trend line, breaking below this level, entering this area and breaking below the 38.2, then I would be confident enough to go short, okay, and have a target down here. Okay, stop loss order near the previous level. Okay, there's two ways to play this, many ways to play this. Again, we're using the short kind of short-term kind of horizon, obviously, without using any other technical indicators. You can add RSI, you can add moving averages, you can do MACD, you can do momentum. You can also use all of these in conjunction to get a much accurate kind of quote area of you to enter a position and use, for example, the other technical indicators to notify you when the momentum is thinning out, when it's wearing out, and then close the trade manually rather than just take profit and stop loss and wait for that to be reached. But a reasonable way to play this between the Fibonacci ratios is this. Okay, so we went past our times. I think this is the end of today's session, guys. If you do have any sort of questions, please let me know in the chat. If not, have a lovely weekend, and we're gonna see you next week for, not next week, but the week after that for another webinar. I don't see any sort of questions coming in, so let's just leave it at that. We've done our time. Yep. Okay, so lovely Friday, Saturday, and Sunday, guys. Take care, and we will see you next week. See ya. Ciao. Bye-bye.